This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Asian stocks set to extend Wall Street losses as the Fed holds rates despite inflation worries, with three dissenters calling for a hike. Longer data Treasury yields jumping to an almost two-decade high.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch.
Big tech earnings rolling in, with Microsoft shares gaining after the bell as growth in its cloud unit accelerates, but Meta and Qualcomm being punished for disappointing revenue forecasts. Samsung's final second quarter results due shortly. And Brent crude prices spike as President Trump says the U.S. plans to hit Iran hard after its missile attack on American forces in Jordan.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia, and there is so much going on for investors to contend with today. Of course, we're still watching what's going on when it comes to the AI and chip sell-off, particularly what next for South Korea. We heard that South Korea is pledging additional measures to stabilize their stock market, curb retail access to these controversial leveraged exchange-traded funds after the sell-off that's wiped billions of dollars off investors' holdings. The limitation of retail involvement will be what we're watching out for in terms of how that impacts sentiment today, but we have seen that two-day 16% plunge in Korean stocks, largely driven by just that outburst of retail selling. Right, stocks just cratering again on Wednesday. So how far do we continue to push this with the Kospi's the key index this month to a record 33% decline and counting? This is the picture as we have the Nasdaq 100 down by over 2%. So clearly that pressure on the tech space remains pretty heavy. Chicago Nikkei futures, though, looking like a rare upside in the day's session. We, of course, are also focusing on how the impact of the FOMC decision is going to play through as well. Take a listen to what we heard Fed Chair Warsh had to say, particularly as there's concerns about inertia at the central bank.
Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute.
There's no shortage of market catalysts today as investors digest the Fed's latest decision and a fresh wave of tech earnings. Oil also jumping as the U.S. and Iran resume hostilities. Let's get to our team. Bloomberg MLive strategist Mark Cranfield is in Singapore. Bloomberg Intelligence Global Head of Technology Research Mandeep Singh joins us from New York, and politics editor Laura Davison is with us from Washington. Mark, let me start with you because there's so much, as we've mentioned, when it comes to news flow. What will markets be most focused on today?
A couple of things I would suggest. Straight away, they've got a very unusual situation to face here. We had a massive steepening in the US Treasury curve, and yet the US dollar fell at the same time. That's a very quick statement from traders that they don't think much of US Federal Reserve policy. The idea that there's not going to be any guidance and that they're not going to be soft on inflation didn't go down well at all with traders in the market. So when you see long bonds falling, yields rising, and the dollar falling at the same time, that's a very quick thumbs down from the market to say, we don't think much of your policy outlook. We don't think you've got any control over inflation, and we're going to do the job for you. So that is something which is very quickly going to translate across the G10, across Asia. That's a cross-asset negative for markets to digest, and they won't be very happy to hear that, particularly at the same time as you've got these hyperscalers raising huge amounts of money, especially in the long end of the Treasury curve. That will add weight to the bond market as well. When the bond market gets dysfunctional, that is not good across the asset class. And of course, even before we get to that, we've got the reopening of the Kospi today. How far down will it go? How volatile? How will people respond to these new measures on ETFs as well? There is going to be another very choppy, erratic trading day going on in Asia, and we may even get some more headlines out of the Middle East. It's yet another day when people will be on the edge of their seat throughout the trading session.
So let's get to the tech earnings first then, Mandeep, because we are now seeing this sort of diverging reaction to the results of big hyperscalers like Microsoft and Meta and how they're taking their AI capex at this point. What stood out to you?
Yeah, I think the market is measuring both Meta and Microsoft in terms of the ROI that these companies are projecting. And in the case of Microsoft, the Azure business had a sequential acceleration. They guided to 45% growth in their 1Q. And Meta, on the other hand, did talk about a few things that they want to do with all this AI infrastructure that they're building. But there wasn't anything concrete in terms of saying that they will be using, compute rentals as the near-term driver, or will it be more agentic offerings that they will be launching based on their own model? And we know, open source is catching up as well. So competition is increasing in terms of, the models that are at the frontier. And Meta, it seems like, still lacks a strategy in terms of how to monetize its investments in AI infrastructure. So it's more uncertainty, and that's why you see that negative reaction. And on top of that, they continue to lose money on the metaverse. I mean, with all the investments, the fact that they will be losing another 20 billions on metaverse reality labs investments is surprising to me, that they are not using that as an offset.
Laura, when it comes to the geopolitical situation, it feels like we're at a bit of a crossroads, right? Anything could potentially happen. What's the rhetoric from Washington sounding like in terms of what steps come next?
Yeah, the mood music from Washington is really quite dark and gloomy. Trump told Fox News earlier today that that he would be hitting Iran really hard, and that it was, quote, the U.S.'s turn to go ahead and hit them after some surprise strikes yesterday from Iran to some U.S. bases in Jordan, as well as some sites in Saudi Arabia, a U.S. ally. This, of course, comes a day before he said that he saw the possibility of a deal coming together and didn't necessarily want to escalate the war. So we're getting some conflicting signs from the president here, but we saw, with oil markets, oil spiking back up to above $91 a barrel. This, is suggesting that the market is not at all convinced that this fighting is going to cease anytime soon. We had 12 days of fighting in a row, then a break for 3 days, and now it looks like we may be back into more tit-for-tat strikes.
Mark, when it comes to how the market is contending with this, there's been that shifting of inflation expectations anyway, given the worries over the energy sector. Has that played into, I guess, if the Fed's not giving forward guidance, or what the market itself is looking ahead to in the coming months?
Well, you can see that the market has decided that it doesn't like the idea that oil prices might stay in the $90 to $100 range for an extended period. That's why you got bond yields around the world rising. And that was even before we had the Fed meeting yesterday. The bond market was already getting very defensive about the idea of extended upward push in inflation. So if we have no end in sight to what's going on between the US and Iran, there's going to be no relief at all from the energy markets. They're also talking about shortages in some of the products, which will keep energy supplies tight, especially at the retail end. Investors, public, are not going to like that sort of thing. That's going to be a negative feedback loop into bond markets around the world, not just in treasuries of the world. Traders can see that very clearly. And once you get a sustained period of people pushing yields higher in those markets, it will feed back into equities as well. We're going to get more days when you see sudden drops in equity markets, as you saw overnight in the US. That's going to feed through to Asia and Europe. We're going to have to brace ourselves for these sudden jolts in markets, and it will be the fixed income market that will be driving it. And that's a very uncomfortable situation. Equity markets just like to focus on earnings and where the next theme is going to come from in terms of whether it's AI or something else. But when you've got the bond market driving the equity market, that is something that nobody likes. It's a negative situation all around. And if the dollar starts falling at the same time, you're just making the pain a vicious cycle that is very hard to break. In the end, it will have to be central banks coming in. The Fed will have to backtrack eventually. They will have to start giving guidance, and they will have to give a very clear message that they want to do something about inflation, which suddenly means the September FOMC meeting will become a live meeting. Whatever Kevin Warsh has to say, the markets will push him in that direction. And when you have 3 dissenters already, it won't take much to push the Fed into a meeting where they have to raise interest rates because the majority want them to do so.
And of course, it will really depend on where oil prices go as well. And we're hearing from President Trump at the moment speaking, saying that we'll finish off Iran pretty soon. Laura, let me turn back to you because, of course, we have seen these various attacks on different fronts, whether it's within Jordan, whether it's within Iraq. And of course, we have the Red Sea front and many more. When it becomes a regional conflict, how difficult will it for President Trump, how difficult will it be for President Trump to be able to end it?
Exponentially more difficult. We've already seen so far that sort of the proxy war happening in Lebanon between Iran-backed groups there and Israel has already complicated this process and made it more difficult to get some of those earlier stage deals together in this war. If this is now extending into the Red Sea, extending into Saudi Arabia and other sites, this just means it becomes a multi-headed, multi-pronged monster that the U.S. is going to have to wrangle in order to stop fighting in all of these different places. This, of course, is while Trump is staring down the barrel of the midterms and his Republican Party is set to lose seats in Congress. They have less than 100 days until those elections. And a new poll out today just showed that 60% of Americans are opposed to increasing attacks on Iran. Only 34% support it. That's the biggest ratio we've seen of opposition towards this conflict so far, really suggesting that Americans are growing tired of this war when there's really no solution on how to end it.
And Mandeep, of course, we're headed towards the Asia Open right now, and we're watching what the implications will be from those big tech earnings. What will you be watching out for in the supply chain, especially when we hear from these hyperscalers who are, of course, not done yet this week?
Yeah, we still have Amazon and Apple who are yet to report. And I think the slight negative, going into the trading day today will be that CapEx didn't really go up for either Meta or Microsoft. And so from that perspective, there was this hope that because of the component price increases, everyone has to raise CapEx, which Alphabet did last week, but we didn't see that follow through from Meta and Microsoft. So it'll be interesting what Amazon ends up doing tomorrow. And I think that certainly is on the cards in terms of, what sort of CapEx increases and follow through we see for the suppliers, going forward.
Laura, we're getting additional news now crossing the Bloomberg Axios, citing U.S. officials saying that airstrikes are being conducted by the U.S. in Iran at the moment. We'll wait to get further confirmation from the U.S. side. But we're also hearing from Benjamin Netanyahu speaking in a recorded ABC interview, talking about the options when it comes to Iran. He says it's Trump's decision. We know that there was some tension there. But if we have now just this resumption of hostilities, Laura, I do wonder how much harder is that off-ramp for President Trump, because it has always seemed throughout the course of even the last round of negotiations that Tehran has been quite willing to stay patient, given that it retains that leverage when it comes to the global oil market.
Yes, this is, Iran has showed incredible resilience, both in being willing to continue fighting as well as continuing to have control over the Strait of Hormuz and be able to put that pressure on the global economy. That we've seen here, if the U.S. is indeed, striking back, that this is, looking like we are headed down a road of attacks continuing to build up here rather than the resolution towards peace, making this very, very difficult for Trump to get a handle on this. We've reported that Trump is growing increasingly frustrated with this war, a war that he started, at the urging of Benjamin Netanyahu. But this is now where we're seeing a lot of this breakdown. Netanyahu was at the White House just earlier this week and had a conversation with Trump. It was after that meeting that we saw some of these hostilities pick up. This is going to be a very, very difficult, situation for Trump to navigate here because there's just no clear off-road, and there just has sort of been more strikes. The U.S. has had certain lines, some civilian sites that are not willing to go after, but I'm kind of middling here in the middle and not really getting a lot of results.
There you have it. Our Bloomberg M Live strategist Mark Cranfield, our Bloomberg Intelligence Global Head of Technology Research Mandeep Singh, and our politics editor there, Laura Davison, with the latest. Coming up next, we'll take a deeper dive into the Fed's decision to hold rates amid some dissenting votes. Take a look at the broader economic outlook and, of course, some of these latest US-Iran tensions that are threatening the inflation outlook. Brown University's Sebnem Kalemli-Ozcan joins us next. This is Bloomberg.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch. CapEx is preparing the ground for future growth. Nonetheless, the precise timing and magnitude of effects on the supply side remain hard to predict. I asked for a good family fight and I got one. I heard a lot of commonality on the questions. Were there different leans on the answers? You bet there was. In the high mountain air in Jackson, Wyoming, I'd like to also frame the big questions. There is a tendency, especially with the proliferation of meetings and press conferences, to get caught up in the myopic.
Federal Reserve Chairman Kevin Warsh there speaking after policymakers held rates steady, but of course referring to those dissenting votes. Let's bring in Sebnem Kalemli-Ozcan, who's a professor of international economics at Brown University. Really great to have you with us. And a good family fight. He got one, that's for sure. I do wonder, when you take a look at the dissenting votes, when you take a look at how markets are now positioning for the next meeting, is there an issue of credibility here at stake?
Thank you so much, Haidi, for having me on the show. So I don't think we are there yet. Of course, you can interpret this two ways. At the kind of the bad side, you can interpret the increase in long-term yields as maybe markets are pricing in a problem with Fed credibility. But my interpretation is not that, because you can also have a positive interpretation saying, okay, those increase in the yields tell us that inflation is a problem. It stays elevated, which, Fed admitted this. It is in their statement, and Governor Warsh said it several times. But it is more of a disagreement, right? There is more of a disagreement between the markets and the Fed, and also within the Fed, which brings us back to this good family fight. One important point here, though, that is put and framed by markets and also within today's development as a disagreement between the hawks and doves. I wouldn't frame it like that, because I think that framing tells you inflation is elevated due to supply shocks, but this is one-off, so they will go away on their own. So Fed can look through. So all we are disagreeing is about the timing, about the, when they are going to disappear and what is their impact going to be. I think this is not the right framing. I think the right framing is the real disagreement is about the model and how shocks propagate. And that is the big unknown here.
And you can see that worry in 30-year yields, right, in terms of where they're sitting at. Does that tell you how concerned markets are, particularly at the longer end there, worried about enduring inflation?
Yes, markets clearly concerned about inflation. Fed is concerned too. It's just that markets are trying to make a sense of this new Fed, right? So we heard a very in a sense, hawkish Fed, in the talk, right? So they admit this agreement. It is a 9-3 hold with 3 dissenters from regional Fed presidents. So the market is trying to understand, okay, everybody agrees on inflation being a problem, but then why didn't you hike today? That's where the market is, right? So market is trying to make sense of the new Fed. If they are going to give us tough talk and they do admit inflation is a problem, when are they going to hike? Or if they are not going to hike, how are they going to deal with this problem? So market is trying to parse this out. Of course, the first reaction should have been long-term yields, and that's what happened. So that's not surprising. But I think we really have to watch what is going to happen in the next few days in terms of how market really try to parse this new Fed information coming from this new Fed that really limits communication and also drops forward guidance.
And as we speak, the backdrop is that even at the moment, we're hearing reports of renewed US airstrikes against Iran. The Strait of Hormuz remains closed. Other key trading paths remain contentious as well across the Middle East. President Trump is trying to rebuild his tariff war as well. So if you take a look at those factors, I guess, what does your research tell us about the enduring stickiness of this type of inflation risk?
Indeed, this type of inflation is persistent, and that's the overarching conclusion and headline result coming from our research, because our research is based on global networks. We try to understand the propagation of supply shocks, such as tariffs, such as Hormuz closure, such as pandemic, such as the energy shock originally came from the Russia's war. We are trying to understand how these supply shocks travel through global production networks, through input-output linkages, but also through global financial networks. So that's, I think, something both markets and the Fed is missing right now, because it is a macro view, but it's a global macro view, right? Not just a very nationalistic macro view. And our research shows us that this type of inflation is persistent under the assumption that Fed looks through. So I do agree with Governor Warsh that inflation is a choice, and Fed is going to determine if these supply shocks are going to be inflation or not at the end. But unfortunately, if Fed does look through and treat these as level shocks, so one-time increase in the price level, this goes both for tariff and Hormuz, then they are going to create persistent inflation, even they disappear. So even, we saw entire Iran issue by tomorrow, still there's going to be persistent inflation coming from that and permanently higher inflation coming from that if, again, Fed looks through thinking this is just a one-off shock. The tariff one, we are now seeing it. Actually, the current over 4% headline inflation, over 3% core inflation has a lot to do, persistence of that inflation has a lot to do with the tariffs from last year.
Sebnem, always great to chat with you. Sebnem Kalemli-Ozcan, who's a professor of international economics at Brown University. Much more to come here on the Asia Trade. This is Bloomberg. Take a look at what we're watching when it comes to the start of trading in Australia. In many ways, this Australian market has really proven itself to show some resilience, particularly as it's been quite heavily loaded with those energy names, of course, as well as being a little bit more protected from the AI names and tech-related names. At the moment, though, we're seeing Sydney futures down by about 0.6%. We have been hearing from the RBA, Sarah Hunter, speaking throughout the course of this morning, really talking about the concerns over inflation, not letting inflationary concerns get into a runaway situation, talking about how the consumer price index downside surprise coming from fuel and travel in Australia. There's still a bit of tightness in the labour market there as well, but really reiterating that the RBA cannot afford to let long-term inflation expectations de-anchor. More ahead on the Asia Trade. This is Bloomberg.
Well, I think Warsh was a little bit more dovish than people expected, which is why you're seeing a rally on the 2-year. And the long bond doesn't like it. The long bond doesn't like that they're not fighting inflation.
I'm going to be looking for, eventually the next speech by Waller, because that's going to give us a sense of what did the core of the committee actually, what is he thinking?
And I also think many people on the board are leaning towards a rate hike as well. We've already gotten a lot of indication of that. And so I do think we do get rate hikes in September. I actually think today would have been better.
The market reaction speaks very clearly that now we need to talk about what is the credibility of the committee, because it cannot only be talk, you will eventually have to follow through. And that's why the probability, given this market reaction now, has gone up quite significantly that they will have to move at the next meeting.
Some of our guests are reacting to the Fed's decision to hold rates steady. So there is this question, right, Shery, as to whether this impacts the credibility of the Fed, whether there's a sense of inertia, what the meaningful implications are given the level of dissent in this FOMC meeting. Does that really kind of get baked into expectations for the next meeting as well? And if so, the question is, why didn't they just move at this meeting? And if you take a look when it comes to that big jump across the long end of US Treasuries, the highest since 2007 for the 30-year, clearly these inflation expectations and concerns are taking hold. We've seen really most of those gains being held when it comes to the energy markets as well, given that we've now seen just these renewed tensions. We're hearing reports of another night of US strikes against Iran. And certainly when it comes to that off-ramp for diplomatic negotiations, things are not looking very clear at all. President Trump saying that the US will strike Iran hard, saying that they'll finish them off soon, right? So none of this setup, particularly if you add in all of these concerns over AI, is particularly clear for sentiment going forward.
Yeah, I mean, it's a tricky time for central bankers, right? They have to really try to adjust to that artificial intelligence variable as well when you have so much AI-fueled demand at the same time, not to mention these massive borrowings around artificial intelligence on top of all of these concerns around the price of oil and inflation expectations. We had some more signals coming from big tech earnings. Microsoft, their results beating, Azure cloud revenue growing 43%, the fastest pace in 4 years. Capital spending likely landing at roughly $175 billion this year. And we had investors, though, punishing Meta. Guidance disappointed. There are concerns that advertising growth may not finance its AI spending. They narrowed their full-year capital expenditure guidance as well. Let's discuss everything to do with the AI ecosystem. Joining us now is Ivan Feinseth, CIO at Tigress Financial. Ivan, great to have you with us. Of course, a very key week when it comes to gauging the market sentiment around artificial intelligence and what all of these hyperscalers are doing. What's really at the core of this divide when it comes to Meta and Microsoft and the investor reaction?
Well, I mean, everybody's looking for perfection because these stocks have had great run-ups and there's a lot of expectations. But I think that any weakness in these stocks is a buying opportunity. They continue to invest in AI. Certainly, Alphabet reported results last week, increased their capital investment another $15 billion to over $200 billion this year, and they say more next year. So companies have to keep spending to develop their AI infrastructure and cloud capabilities. And I think the AI investment theme has long to run, and there's a lot of investment behind it.
I guess now the question for investors is whether or not all of these investments will actually pay off. Why do investors think that for Meta, that might not necessarily be the case as fast as it is for Microsoft?
Well, because Meta, they depend on Meta's advertising revenue to invest in their AI infrastructure. And the quarter said the revenue was a little soft. But I mean, I think that you have to look beyond that and look for the opportunities that they are creating that will eventually, AI will drive increased advertising revenue.
Of course, we're also watching the AI debt space, right? I mean, what does it tell you, the fact that we are starting to see financing fatigue, perhaps, even when it comes to Meta and their Texas data center, BlackRock selling that debt to finance it, and that just coming in at 1.6 times the deal size, which is the lowest cover for these major AI projects. Does this give you an indication that right now we're not in a competition for technology as we are for financing, and who wins?
Well, there's recently been a lot of controversy over data centers. As much as we need them, there's been pushback on where we can put them. New York just declared a moratorium on new data centers, which I think was really economically negative to the state. And then you have controversy that we may not need as much or as large a data centers as predicted because the processing power will continue to shrink, use less power, need less resources, which is also positive. But I think that we are going to continue to need a lot of cloud storage and a lot of data center capacity because every day the content continues to be produced, which needs more storage. It needs the ability to analyze it faster, access it faster. And I think those are the key underlying trends, and we'll need greater and more powerful processors, which companies like Qualcomm, NVIDIA, and Intel continue to produce.
NVIDIA really at the center of what some people are calling and worrying about, which is circular deals, right? What are the implications if we don't see this AI infrastructure build out paying up as fast as investors expect?
Well, we've seen this concern before. Look, NVIDIA has a tremendous over $100 billion in excess cash. So they might as well get into investing in the industry that they continue to believe has tremendous growth. And look at the revenue growth of NVIDIA alone. And they're on track for their newest processor and eventually the Blackwell, eventually the Feynman. So they continue to roll out new processors that are faster and more powerful and use less power and continue to struggle to even meet demand.
When it comes to new Chinese AI models, the fact that they're more efficient, does that mean perhaps more gains for NVIDIA? How does that really compare to what it means for companies like NVIDIA on the one hand, and on the other, OpenAI and Anthropic, for example?
Well, there's concerns of increased competition, but the more models that are created and the more data that is created will only increase the demand for data center capacity and processor capacity.
When it comes to the chip side of things, we continue to talk about this memory shortage and the issue with pricing. When you look at it broadly, what would that necessarily reflect of what's happening in the Asian space as well? We do get Samsung earnings today.
Well, I would like to see a pickup in volume. So I think you will see memory prices come down. We need to see it come down because they've just gone crazy over the past year and a half or so. So you need prices to come down, and that will be offset by a volume pickup because there's just a tremendous amount of demand.
Does that also perhaps give an opening to all of these Chinese companies, despite the fact that we are seeing these export restrictions and the increasing rivalry between the U.S. and China?
Well, that's going to be a continued rivalry for some time. I mean, Trump is committed to make the U.S. #1 in AI. It is the technology of the future, and it is important to both the U.S. economy, U.S. security. So it's a major focus, and he's putting a lot of resources behind it, including, look, the investment that he's made in NVIDIA and other data center infrastructure. So this is a very powerful competition that the U.S., I believe, will win.
Ivan Feinseth, really good to have you with us, CIO at Tigress Financial. And take a look at some of the stocks that we're watching when Japan opens shortly. SoftBank will be in the spotlight, in part because of its exposure to the AI trade, and also because its biggest investment arm holdings saw big declines in after-hours trading. The chip design company's results point to sluggishness in the smartphone industry, overshadowing a lucrative push into data center technology. Also watch chip testing equipment maker Advantest. We saw its ADRs rise in the U.S. session after it raised its full-year forecast well above market estimates. The company touting continued strong demand from the AI boom, Haidi.
Yeah, we do have some breaking news, Shery, when it comes to Sony at the moment. Just some breaking news with Sony approaching Tamron with a 200 billion yen offer. This is a lens manufacturer with a buyout proposal of around 200 billion yen, according to reporting from Diamond Online, citing an unidentified report. But we are now hearing that Japan's Tamron has received that non-binding takeover offer from Sony. So we'll be watching that very closely. The approach reportedly was made back in January. We haven't had comments from neither Sony nor Tamron at this point, but we'll bring you more details as we get them, Shery.
Right, Heidi, and still ahead, South Korea tightens curbs on leveraged ETFs as it tries to stop a rout that's wiped billions of dollars of investors' holdings. We'll have the details next. This is Bloomberg.
South Korea has pledged additional measures to stabilize the stock market and curb retail access to leveraged exchange-traded funds after a rout that wiped billions of dollars off investors' holdings. The steps were announced following an emergency meeting hosted by the Finance Minister, Koo Young-cho. Let's get to Seoul, and our Deputy Bureau Chief, Hee-Soo Lee, joins us now. So, Hee-Soo, we know that these concerns obviously have been bubbling away for a while. So, in terms of the timing, obviously that massive retail sell-down over the past couple of days has come at the time that these new measures have been announced.
Right. So the immediate trigger was an extraordinary market sell-off. The Kospi has fallen roughly 40% from its June peak, and the market has hit circuit breakers for 2 consecutive days as of yesterday. Lawmakers and regulators increasingly concluded that newly introduced single stock leveraged ETFs amplified volatility, particularly because they were heavily concentrated in Samsung Electronics and SK Hynix. The government now says these products contributed to excessive market swings and is responding with additional restrictions aimed at reducing speculative retail trading.
Give us a little bit of history as to why these leveraged ETFs, particularly when we talk about the single stock ones, right, have become so controversial.
Right. So the controversy isn't just about investors losing money. It's about whether regulators approved the products that were inherently too risky for South Korea's market structure. Unlike more diversified markets, Korea's stock market is heavily dominated by a handful of companies, especially, like I said, Samsung and SK Hynix. One of the opposition party lawmakers yesterday said that allowing 2 times leveraged products on individual stocks in such a concentrated market magnified price swings. He even described it as a policy failure, saying authorities were too interested in boosting the stock market over protecting financial stability.
I guess the question is whether these new measures is enough to put support under this market, right?
Yeah, so they could help speculative trading, but many questions still remain. The government plans to cap retail exposure, increase trading costs, and create legal authority for emergency intervention, drawing on overseas examples like Hong Kong. However, officials haven't said how strict these investment caps will be or how much trading costs will increase. So while the direction is somewhat clear, the effectiveness will depend on the details.
Bloomberg Deputy Seoul Bureau Chief Hee-Soo Lee there with the latest on the volatility in the South Korean market, which a lawmaker there has called South Korea becoming essentially a casino. Of course, we talked about those market fluctuations, a big deal to do with the earning results from SK Hynix, from Samsung. We're expecting Samsung today. I mean, this stock too. It rallied 70% this year, but it came really down from that peak in June. And the SK Hynix, despite the fact that we saw their 6-fold surge in quarterly profit, we continue to see the downside pressure. And of course, in the overnight session, we also had a sell-off when it came to Wall Street chip makers. The Philadelphia Semiconductor Index down more than 5%. AI capex and momentum trades in focus today as semiconductor weakness continued despite the fact that the Fed actually paused. More now with our markets reporter Anthony Stevens. And Anthony, I'm talking about the FOMC, a 5th straight pause for what investors had considered potentially a more live meeting than others. And yet we saw the incredible downside pressure for chips.
Yeah, it was a very interesting kind of tone to the meeting, right? Governor Warsh is basically asking the market to do the job of tightening for itself until he is very sure about what to do. It's a very data-dependent Fed, and he's asking the market to bear the burden of adjustment. Well, the market bore the burden of adjustment, and the first adjustment was a big move in the long end. The 30-year moved above 5.2 on the yield, but also speculative investments in equities collapsed. The fall in the momentum trade is what is catching eyeballs here. It's not the headline equity news. It's the fact that the Goldman Sachs Delta hedged momentum index fell 6%. This is a Delta flat index, and for that to be down 6% indicates a level of pain in the tech trade that is starting to feel more macro. The results season as well is showing multiple earnings beat and raise that is being greeted with big falls. So we saw, for example, ARM, ASM International, and other kind of names.
And Anthony, let me just interrupt you for a second because you're mentioning those earnings, and I'm getting them right now on Samsung's second quarter results. When it comes to their net, it's actually a beat, 71.2 trillion won. The estimate was for around 78 trillion won. We're also talking about their operating profit coming in at 89.49 trillion won. Now, these are the full results. Remember, we were expecting them after their preliminary quarterly operating profit came in at broadly these lines. So we're sort of holding steady with sales coming in at 171.5 trillion won. We want to see a little bit more breakout from here when it comes to the divisions, but we will be very much focused on the memory profitability, the HBM demand, and even perhaps a little bit of their smartphone business because we have seen the weakness there. But returning to Anthony, as we get more lines from Samsung dropping at the moment, I mean, I mentioned it earlier, but this has been a stock that has soared with the Korea market, but at the same time, it's plunged as well, right? I mean, how high are the stakes for these investors going into these Korean semiconductor makers when we also saw the volatility immense in SK Hynix?
Yeah, so Samsung is a very important kind of foundational stock in Korea because it also has the foundry business. It has the DRAM business in much bigger size than Hynix. So this kind of product mix should be helpful to Samsung, and we should listen to the earnings call and the analyst briefing afterwards to see whether they captured some of the huge increase in the DRAM price, which they are much more exposed to. Also, any kind of progress on the foundry business in competition with TSMC and how much business they're getting from custom silicon is going to be very interesting. And then finally, their capex. How much money are they going to spend? How confident are they that they're going to get that money back in terms of return? That is going to be very interesting. And lastly, we're going into a day where the retail has taken a big bath, right? So will they come in to buy this result? Will foreigners come in to buy this result is another question. We saw the Korean won bounce quite hard yesterday, actually, as foreign selling kind of slowed into what was a very deep downturn. So you saw foreign selling only coming in around $600 million, which for the size of the selling is not that big. So we'll be very interested to see the flow dynamics and the details of the reporting in this number.
Yeah, Anthony Stevens, there, our markets reporter, as we're getting those details that Anthony mentioned. Let's break it down. Second quarter chip operating profit coming in at 89.2 trillion won, which is also surpassing expectations when it comes to the second quarter mobile networks operating loss. And remember here, we had seen some weakness when it comes to the mobile side of things, at 700 billion won. Let's turn to the sales number. Chip sales, 127.5 trillion won. Mobile network sales, 33.2 trillion won. So we'll continue to get these lines from Samsung, but suffice it to say that when it comes to the net, we have beat a little bit to the upside, but futures going into the market opens in South Korea still pointing to a little bit of pressure. Of course, not surprising given that we saw that market reaction to SK Hynix's results as well. This is Bloomberg.
The latest from the corporate front now, and the Pentagon has awarded major defense contracts worth billions of dollars as the Trump administration works to boost weapons stockpiles drained by the Iran war. Lockheed Martin won a $59 billion deal to sharply expand Patriot missile production. General Dynamics and Huntington Ingalls secured contracts worth close to $76 billion for nuclear submarines and upgrading shipyard infrastructure. Moonshot AI has secured a $35 billion valuation after raising $3.5 billion in a financing round. Sources say that's far more than the Beijing-based startup was aiming for as it rides on the success of its breakthrough Kimi K3 model. The company is now seeking funding at a $50 billion valuation, aiming to secure capital before an IPO in Hong Kong as soon as this year. Starbucks has raised its full-year outlook after quarterly results topped estimates, suggesting that CEO Brian Niccol's efforts to win back customers with faster service and new products are gaining traction. The coffee chain posted a fourth straight quarter, I should point out, of comparable sales growth. The company says results reinforce confidence in its growth trajectory. Adani Enterprises has posted a net loss of $121 million for the 3 months ended June 30th, compared with a profit of $93 million a year earlier. The loss stems primarily from exceptional charges linked to the resolution of US sanctions investigations. Revenue for the same period surged 50% to about $3.8 billion.
And Haidi, we're waiting for the market opens in South Korea as we're watching Samsung Electronics. They just announced their full results, their second quarter net beating expectations, coming in at 71.2 trillion won. And a big chunk of it was their second quarter chip operating profit. The chip side of things, $62 billion, leading to the broader overall profit at being more or several times more than the June quarter a year ago. So the chip division really accounting for most of it. Samsung saying that it expects chip demand to remain strong in the second half, and they expect the overall earnings to grow in the second half as well. Of course, Samsung, huge market weight on the Kospi together with SK Hynix. And remember, SK Hynix also had a six-fold surge in quarterly profit, but their stock just plunged in the previous session. So we're seeing right now the setup, which is for more downside in today's session. You can see even Nikkei futures pointing to some downside today. We continue to see the yen stabilizing near multi-decade lows, but we're still headed towards that Bank of Japan policy decision on a very busy week, right? I mean, we just had the FOMC holding for a fifth straight meeting. We're still digesting also big tech earnings. The market opens in Sydney, Seoul, and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and Haidi, seems the narrative hasn't changed this week. We're still watching central banks, a little bit more clarity coming from the U.S. with the FOMC holding for fifth straight meeting, but they have three dissents that wanted a hike. And of course, we continue digesting tech earnings, not to mention the latest Iran-U.S. tensions.
The themes are the same, but certainly the intensity has really ratcheted up, right? Whether you take a look at this reignition of hostilities and the war, these questions over potential policy missteps, but certainly dissent at the Fed, but also when it comes to these Asian markets, particularly for Korea, where to next after the fast and furious selling of the past 2 days?
Yeah, lawmaker in South Korea calling the country a casino now. But take a look at how Japan is coming online first, because we are headed now towards a Bank of Japan policy decision. We have the FOMC out of the way. Right now, the expectation is for a hold for the BOJ. Of course, we continue to digest more inflation numbers in Japan as well. We're seeing some price pressures. We will be watching the JGB space very closely. We continue to see that downside pressure, and the fact that potentially we could get a food consumption tax cut here in Japan, which reports say the government is now debating. That could lead to perhaps more upward pressure when it comes to yields, according to analysts. The Japanese yen still holding at that mid-163 level, still around the lowest levels against the US dollar in 4 decades. But we're watching the tech sector very closely, right? Because we had big tech earnings, hyperscalers, the likes of Meta, the likes of Microsoft, really diverging reaction from investors. Take a look at how South Korea is faring, because despite the fact that we were watching hyperscaler results, the consequences might be bigger for these supplying companies like Samsung, SK Hynix. Of course, their capex affects how they sell this year, for example. And we just got Samsung earnings, and the results were broadly to the upside, beating expectations. But remember, expectations are so high already that you saw SK Hynix with that 6-fold jump in profit, and then you saw the stock plunge. And in fact, even in today's session, is down more than 2%. Samsung seeing a 1% gain. And this stock has been so volatile, right? I mean, it's up about 70% this year, but it's just crashed since the June peak. And it's not just Samsung and SK Hynix. This really has an impact on the broader South Korea market, right? The Kospi, I mean, 2 consecutive circuit breaker triggers. That has been unprecedented for South Korea. So there's a lot of alarm within the country right now, Haidi, on what to do with this volatility.
Volatility when it comes to the Treasury space as well, right? In fact, there's an argument that what we're seeing from the Fed, the level of dissent, the expectations now being set up for the next meeting, really setting up the broader US bond market for further rallies. But certainly none of that is more evident than when you take a look at the long end of the curve, the 30-year yield soaring to the highest since 2007. So almost 20 years ago, we saw these levels. Rate swaps reflecting roughly 60% probability that FOMC officials will boost borrowing costs to come that September meeting. So, despite that dissent and clearly what Fed Chair Warsh referred to as a good family fight, it did give some sense of clarity to what has been a deeply divided Treasuries market in terms of where that inflation outlook is headed to next. Take a look at Brent. We are seeing a little bit of softness there, pull back. This despite, of course, these ongoing concerns about what next when it comes to the US-Iran war. We've heard Axios reporting that there's been another night of strikes being resumed from the US on Iran. President Trump saying that the US would strike Iran hard. He's actually also in a tele rally made references to we'll finish them off soon. But it's very clear that when it comes to this particular conflict, as well as the regional proxy conflicts, that off-ramp is becoming increasingly difficult to find. Also watching Australia, the ASX muted start to trading, about 0.3%. We'll be watching the likes of Rio Tinto after those numbers came out through yesterday. Of course, in the thick of earnings season here as well. We also did have those comments from the RBA, Sarah Hunter, really warning of the need for the RBA to not let inflationary expectations become de-anchored in the longer term. And of course, that concern about sticky inflation expectations is front of mind for the Fed as well. Despite that decision to hold, Fed Reserve Chairman Kevin Warsh has reiterated that the Fed remains committed to delivering price stability.
Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch.
Bloomberg Economics Chief US economist Anna Wong joins us now from more. So I guess the question is the dedication to price stability, the dissenting votes, the concern over de-anchored inflationary expectations. What we're seeing in the Treasury markets clearly reflects some of those investor concerns. So why didn't they just move at this meeting?
Yes, so I think that Kevin Warsh ultimately decided he will not favor a hike today, basically because he's waiting for the task force assessments of how one should think about inflation. He had several times expressed frustrations about current status of inflation measures. And for example, the Bureau of Economic Analysis is due to announce some major revisions to core PCE deflator come September. So I think Kevin Warsh basically wants to wait until September. And so September will be definitely a live meeting for a rate hike. And I think the market's reaction today is basically calling Kevin Warsh bluff on his determination to deliver the 2% inflation.
We are not just contending, of course, with some of those domestic inflation pressures. There's, of course, the ongoing war and the threat over global energy supplies and oil prices. There's Trump trying to rebuild his tariff wall as well. How does this feed through to how big a threat it is that perhaps this inertia or this choice to wait a little bit too long is going to be a policy mistake?
Yeah, so in terms of the new tariff war, our trade team estimated that the new Section 301 and 338 will only boost effective tariff rate by 0.1%. So that's basically an effective tariff rate of roughly 10%. That's still lower than before the IEEPA ruling or than last year. And also, our team has looked at the tariff pass-through, and we estimated that the most of it is already over with, and looking forward, whatever inflationary impulse remains in CPI is not really attributed to the tariff. So I think the Fed was correct to keep on hold today. I think the mistake is that Kevin Warsh didn't really explain very well why he paused, and furthermore, he didn't explain what are the criteria for the Fed to hike in September, and as a result, the long end of the bond market just revolted.
Bloomberg Economics chief U.S. economist Anna Wong there with the latest on the Fed. Let's bring in Ken Wong, Asian equity portfolio specialist at Eastspring Investments. Ken, really great to have you with us. I mean, we saw the volatility in the U.S. market, not only reacting to what the Fed did, but also to all of these big tech earnings. The fact that we have AI-fueled demand, but at the same time, this concern about the AI infrastructure build-out, how does that bode for Asian markets when we continue to see this on and off sell-off?
Yeah, I think the fact is that suppliers are generally seeing quite a bit of profit taking this month, as expected. Now, overall, when we look at whether it be it semiconductor companies, whether it be it memory storage companies, or even electronic components companies, nobody has actually been immune to the sell-off. But generally speaking, for us, when we're looking at the Asia tech market as a whole, we feel that electronic component makers still do have better opportunities, because when we look at going forward, whether it be it ASPs, whether it be it specifically margins because of a lack of competition for electronic components, there's going to be pockets and areas where now we would expect for some investors to really start to bottom fish and start looking for some opportunities, especially given the correction that we've seen so far in July.
But you're actually underweight when it comes to semiconductors and memory. Why?
Yeah, the fact is that we've been underweight semiconductor as well as memory now for the last 6 months. Overall, in our view, we think that electronic components are actually the better way to go, because generally speaking, when we look at the average sales price, or specifically when we expect for overall margins, we expect things within the semicon as well as especially within the memory space to gradually start to weaken. The fact is that there is going to be a lot more excess capacity, which is going to be out in the marketplace, especially in 2027. The fact is that, yes, while we are continuing to see a rise in, for instance, DRAM or NAND memory prices, generally speaking, when we look at the change in terms of the overall rise in prices in memory, especially into 2027, that is probably going to soften a bit more. And this is why you're seeing that sell-off right now, in particular for July, especially when hyperscalers are, potentially going to have to reduce specifically some of their AI CapEx spends in 2027, potentially. Then there's going to be actually notion in terms of what we're going to have to look at in terms of opportunities. But with that said, we're looking at changes in terms of the delta, not necessarily overall decline in AI CapEx, but maybe not necessarily growing as high as optimal as earlier expected.
Okay, does that mean then that when it comes to regions, you would prefer, say, Japan, where we have lots of electronic components makers, as opposed to South Korea, which is dominated by these semiconductor makers? And if so, what would the implications be of the BOJ continuing to tighten? How do you position this week?
Yeah, overall, Japan and Taiwan are key areas when we talk about electronic component makers. The fact is that the competition for electronic components, especially amongst global competitors, is definitely not as heavy as what we see with semiconductor as well as with memory. Now, ultimately speaking, when we look at what's happening with central bank policies, I think, specifically what's happened with the Fed earlier today in terms of not raising interest rates, that does help, because there was a notion that if the Fed was going to raise interest rates, that would have an impact in terms of potential AI CapEx capex decline as a result of a rise in interest rates. So at least we get that out the door in terms of, well, the Fed is on hold at least for one more time. So potentially, we might not necessarily see the weakness. I think more importantly, what's going to be important is more guidance from companies, not necessarily just from hyperscalers, but also from traditional companies. And overall, in terms of their second half, and that, more importantly, into 2027, what's going to happen with their AI capex as well? Because we know that hyperscalers and other tech companies do spend quite a bit when it comes to AI capex, but generally speaking, traditional companies are also spending quite a bit now on their AI capex. And it's going to be interesting to see, specifically with what we're seeing, whether or not we're going to also see some potential pullback in terms of AI capex from traditional companies.
Ken, how big is the oil variable in markets like Japan, where they're very dependent on Middle Eastern oil? But not just oil, we're talking about petroleum byproducts as well that go into all of these factories, including, of course, component makers.
Yeah, and that is going to be something that we're going to have to carefully keep an eye on. The fact is that from our point of view, we still see higher oil prices, at least for the immediate future. Now, even regardless of what's happening in the Middle East, whether or not we do get an agreement, the fact is that higher oil prices is here to stay, at least in the near term. So I think a lot of companies have to price this in. And ultimately speaking, not have the notion that potential oil prices can go back anywhere near where we were, let's say, in January and February. So this is going to be something that's going to be very important, and higher expectations in terms of inflation. And companies will have to actually, provide specifically or have better guidance in terms of what they're going to be doing because of the rise of higher inflation.
When we talk about usually the tech sector and semiconductors, anything related to the AI trade, e-commerce, we just group China completely separately because of their idiosyncratic stories and how they're isolated perhaps in a way because of these rivalry and competition with the U.S. Is that also a market that you would look into, especially when it comes to electronic components?
It is. And the fact is that electronic components is one area. So we see specifically in areas like PCB, substrates, transceivers, there's a lot of companies in China that's also doing this. But more importantly as well, I think once we move from agentic AI and potentially to physical AI, industrial companies are going to play a very bigger part in that as well. So we see a lot of opportunities, especially within the China onshore market and also in Japan, where industrial companies do have quite a bit of advantage, especially when we get to this next stage of AI development with physical AI.
Enough to offset some of those macroeconomic fundamentals and weakness that we're seeing, whether it's in the Chinese economy, because we've been talking about the property sector forever, or here in Japan, where you continue to see a crumbling Japanese yen having an impact on households.
Yeah, there's going to be a bit of a balance. The fact is that, yes, while one part of the market, in particular right now, in terms of AI capex, in terms of specifically the electronic component makers are doing well, there is a lot of other companies out there in the marketplace. But I think we have to take a step back as well, because given the recent weakness that we've been seeing across the board for anything tech related, we're gradually seeing some of the flow heading back into more some of the traditional companies as well, which has benefited. So I think, there's two sides of the coin. So there are opportunities, especially when it comes to some of this pullback. But I also want to address the point that we saw similar pullbacks within the tech sector in 2025, especially during that March 1st to up to Liberation Day, where a lot of tech stocks and generally tech markets as a whole dropped anywhere between 25 to 30% as well. But by the middle of June of 2025, those losses were made back as well. So we have seen something similar last year as well during that March up to April 10th period.
Yeah, we'll keep that in mind. Ken Wong, really good to have you with us and your perspective, Asian equity portfolio specialist at Eastspring Investments. We have more ahead. This is Bloomberg.
Take a look at what we're watching when it comes to the reaction to these Samsung numbers, right? Seeing robust chip demand in the second half. These numbers, of course, coming amidst really something of an existential crisis, where with investors really questioning the huge amount of capex spend and investment that's gone into some of these names versus potentially signs of waning demand. Chip profit for Samsung soaring over 250-fold on the back of these AI memory shortages. The chip operating income coming in at $62 billion for the June quarter. That was a big beat on estimates, and we are watching pretty much a downside picture for that stock, though. SK Hynix also lower by 6.6%. This after we've seen that 16% retail-driven sell-off in the Korean market. Kakseo trading there lower by 1% there as well. There are some hopes, though, that this is going to spark some stepped-up shareholder returns for that stock. Let's get some more on the Samsung results, so with our Seoul Bureau Chief, Kath Barton. So we needed a robust set of results, really, to try and provide a bit of support over what has just been an extraordinary couple of days of sentiment freefall for Korea.
It's absolutely right. Hopefully, this will be good news for investors. But obviously, Samsung, these are record. It was an absolutely historic quarter for them. Record profits for their semiconductor division. Obviously, their mobile phones and their other electronics didn't do quite so well. They actually tipped into a loss. But the semiconductors are just doing so outlandishly well that it's carrying the whole company at this stage. We'll have to see, as you say, how investors respond. Obviously, yesterday, SK Hynix was less positive. I mean, even though they were also record results, they didn't meet expectations, very lofty expectations. So there was this, we had a circuit breaker yesterday, and let's hope that today we might have a slightly calmer trading day on the Kospi. We'll have to see.
Yeah, I mean, it was interesting. SK Hynix was also emphasizing the fact that they had multi-year contracts in order to really emphasize the stability for their company. What did we hear from Samsung?
Samsung is similarly very positive. They're emphasizing that they really see robust demand for the second half of the year. They anticipate that these shortages are going to continue, the memory shortages, and for their bottom line, that's obviously incredibly good news. So they are very positive, and they're emphasizing the stability of this demand longer term. But whether investors are impressed by that amid obviously much broader questioning of AI, the AI trade, I think remains to be seen.
Bloomberg Seoul Bureau Chief Kath Barton there with the latest on Samsung. And of course, Kath also mentioned the fact that we had a little bit of weakness when it comes to the mobile sector. We have seen the shortages of memory really hitting that sector, which has also hit ARM, of course, because this is the big company when it comes to those smartphone processors, and their underlying AI story was pretty strong, but then valuation sentiment now dominating this stock, and the majority shareholder of ARM being SoftBank, you can see the downside of more than 3%. We also got the results from Microsoft, and shares actually climbing in late trade after better than expected fourth quarter earnings, helped by continued strength in cloud computing and artificial intelligence. Bloomberg tech anchor Ed Ludlow reports from San Francisco.
Microsoft delivered what investors wanted to hear on two different fronts: AI growth and some clarity around AI spending. Azure, the cloud computing unit, grew 43% in the quarter. That's its fastest pace since 2022, well ahead of expectations. And we got a figure for Azure annual revenue topping $100 billion for the first time. They looked as well outside of financials. So think about how are the AI products doing? Microsoft said that 365 Copilot now has more than 30 million paid seats, up from 20 million 3 months ago in the March quarter. A beat on the top line, a beat on the bottom line. But the clarity on spending bit, on a quarterly basis, capital expenditures, $41 billion. That represents a jump of 70% year on year. An accounting nuance. Microsoft lowered its calendar 2026 CapEx expectations to $175 billion from about $190 billion, but stressed this does not represent a lower investment. It stems from extending the useful life of data centers and office buildings from 15 years to 25 years. And what that does is it shifts more future data center leases from finance leases to operating leases. Essentially, net, the spending and investment expectation that Microsoft has is exactly the same. Nevertheless, that communication was really cheered by investors in the after hour. Also, perhaps the strongest signal on the AI future spending, Microsoft disclosed $130 billion of new data center leases and commitments during the quarter, and that brings the total future lease commitment for Microsoft to $329 billion. A year ago, it was just shy of $200 billion. Bottom line, Microsoft's message wasn't that it's spending less on AI. It's that AI demand remains strong. Azure is accelerating, and despite what are accounting changes that lowers a reported CapEx figure, the underlying infrastructure build-out continues at pace. This is Ed Ludlow for Bloomberg News in San Francisco.
And we have more on tech trading across Asia on the Asia Trade. This is Bloomberg.
Take a look at what we're watching when it comes to crude prices at the moment. Brent coming online a little bit softer. We're seeing New York traded crude also down by just about 1%, but really holding most of those gains that we've seen over the past couple of days. Also, President Trump vowing to hit Iran. We're also seeing US stockpiles slumping as well. But at the moment, we are getting confirmation that US forces have begun launching strikes versus Iran at 8 p.m. Eastern time today. And that is a confirmation from the US that we're getting at the moment. The US forces have begun launching these strikes. A powerful response, I quote, yesterday's attempted Iranian attacks on US forces based in the Middle East. We're also watching European natural gas prices. They've taken a bit of a jump after those comments from President Trump renewing threats against Iran. And he says that they will strike back after yesterday's attack that targeted a military base in Jordan. Let's get the latest with our Bloomberg editor, Michael Heath. So certainly no off-ramp in sight, it seems.
No, I mean, we're sort of back to tit for tat. And it's really interesting because it looks like, at the end of last week that the US paused these its strikes, and now that the Islamic, the IRGC has taken up the mantle and sort of tried to provoke the US with this attack. Now they say they were actually responding to a US measure, but there'd been no reporting of that. So it almost looks like this sort of the hard alliance side in Iran is sort of wanting to keep the whole process going, which makes life very, very difficult for President Trump, because he obviously is pretty keen to extract himself from this and find a way to get energy supplies flowing again. So yeah, really interesting.
And we heard Trump speaking at a tele rally in the last hour. Still sounding quite buoyant, saying that we're going to hit them hard, we'll finish them off soon. Operationally, I don't know what that means.
Yeah, I mean, look, there's a lot of rhetoric, isn't there? And in a sense, it's a test of it's a real test of wills here. Bravado on both sides, definitely from Iran's side and from the IRGC, that they can take this and they can keep it going. And from President Trump, that he likes to be the man, and he these sort of things he won't accept. And you could just see that this is a provocation in so many respects. They know that they're going to get a response from him. What's interesting also is we've obviously had a bit of a widening of this too, with Saudi Arabia sort of joining the fray with these strikes in Iraq as well. So, yeah, it does seem like this is going to drag on for a bit of time now.
Bloomberg editor Michael Heath there. More ahead here in the Asia Trade. This is Bloomberg.
Well, I think Warsh was a little bit more dovish than people expected, which is why you're seeing a rally on the 2-year. And the long bond doesn't like it. The long bond doesn't like that they're not fighting inflation.
I'm going to be looking for, eventually the next speech by Waller, because that's going to give us a sense of what did the core of the committee actually, what is he thinking?
And I also think many people on the board are leaning towards a rate hike as well. We've already gotten a lot of indication of that, and so I do think we do get rate hikes in September. I actually think today would have been better.
The market reaction speaks very clearly that now we need to talk about what is the credibility of the committee, because it cannot only be talk, you will eventually have to follow through. And that's why the probability, given this market reaction now, has gone up quite significantly that they will have to move at the next meeting.
Some of our guests are reacting to the Fed's decision to hold rates steady. Of course, we've talked at length about those dissenting votes and what that means going into signalling for that next meeting in September. Swaps pricing is certainly shifting towards it's almost a done deal, I guess, as we get closer there. But this is the picture as we look at Asian stocks trading at the moment. Tried a bit of a bifurcation there. The Nikkei 225 seeing upside of 1.6%. We have heard some analysts saying that the recent sell-off kind of portends just future opportunities. The Kospi is also maintaining some semblance of of upside here, about 0.25% in light of the 16% two-day sell-off that we've seen. Some of those control measures when it comes to retail involvement in leveraged ETFs. We've heard about a lot of effort to try and put a floor under this market, because at one point yesterday it was very much a classic catch a falling knife situation there. We also have some pretty robust Samsung numbers for investors to pour over as well. In Australia, modest downside of about 0.5% as we have heavy earnings season here starting to get underway there as well. The real story, I suppose, is really what we're seeing when it comes to treasuries at the longer end, that 30-year yield jumping the most in almost 2 decades. When it comes to tech, though, Samsung may provide some support for Asian tech names today. Sentiment clearly remains fragile. Hong Kong waiting for a big IPO. Taiwan seeing sharp margin drawdowns. Stakes are very high. Let's get back to our markets reporter, Anthony Stevens, in Hong Kong. So thin ice or tippy toes, what are we doing here after what has really been an extraordinary first half of the week?
Yeah, in context, today seems like a relaxed day, right? And that's quite an amazing statement, given that, Hynix is still down pretty sharply again today after results. Samsung is really helping to draw kind of the line under that. Pretty solid results. The market is taking it well. So, kind of normalcy returns. You get a good result and you get a stock trading higher. And that is going to calm some nerves, especially given how big Samsung is as part of the MXAP. But under the hood, there continues to be this big single name idiosyncratic risk around results. We had that in Europe, we had that in the US, and we're going to come back to that in the Japan trading session as well. You continue to see this kind of bifurcation between the smaller chips, the kind of simpler chips in the MLCC or passive component sectors moving around a lot, and that has set up Taiwan for a very interesting session. You see Taiwan margin balances came off very sharply yesterday. They continue to fall. They have been falling for about a month or so. And that's going to be very interesting. When does Taiwan regain its kind of mojo and its retail investment kind of bullishness? Or will those kind of subsectors underneath TSMC continue to suffer these big drawdowns? That sets the stage for Zhongji Innolight. This is a photonics maker. It's a very specific kind of component that needs continued large sums to be invested in data centers to justify its valuations. So it's going to be very interesting to see how that trades in Hong Kong today.
Yeah, especially given that it's the biggest public debut in 7 years or so. How big is the excitement right now? Not just in Hong Kong, but across Asian markets around anything related to artificial intelligence.
Yeah, and you raise a good point, right? Like, it's the calendar of ECM and DCM capital raising is extremely robust. But now we are getting a kind of a question on the demand picture, the results picture of these stocks that are already listed. So what that does to the calendar in the weeks and months to come is going to be very interesting. Does pricing move? Pricing has been quite aggressive here on the debt side, especially, but equities as well. You saw some really good gains from IPOs. Does that trend continue? And does retail, having taken these huge losses across the US, across Japan, across Taiwan, across Korea, Hong Kong, does retail continue to buy these IPOs and chase the AI upside? That's going to be a huge question in the back end of the year.
Market reporter Anthony Stevens there with the latest on the tech world, and of course digesting all of those earnings and exciting public debuts also coming up. Here in Japan, we're watching politics. The Prime Minister, Sanae Takaichi, facing her first real political test with sliding poll numbers, raising questions about whether she is focusing on the issues that voters really care about. Bloomberg Opinion columnist Garode Reedy joins us now with more on this. Garode, I've always been curious, in a country like this, when you have such a political structure, how much does public opinion polls actually matter when you have the backing of your own party?
Well, of Of course, Takeshi has the backing of her party, but obviously the thing about the LDP is that it's a very broad church. There's lots of different factions, some of whom support her and some of whom are completely opposed to her. So whenever you see polling numbers like this, it gives opportunities for her opponents. You know, the opposition isn't up to much in Japan, but her opponents within the party are certainly looking for an opening. And, you know, Takaichi is, you know, the next time Prime Minister Takaichi is the person, the next time there is an election, who has to lead people into an election. Anytime an election is coming up, people start to get a little bit concerned about whether they're going to keep their jobs or not. So polling numbers are actually one factor. You know, they're quite an important factor. But, you know, I would say that despite, you know, the numbers were big, but they're coming down from a very high place. They're still, you know, in most of the polls, still show her with a majority of people supporting her, which is still quite unusual for this stage in a premiership.
So what's the issue then right now? Is it about having to reorder her political priorities?
That would be my take on it, yes. So in the first Diet session, she has focused on her growth strategy. I am in favor of her growth strategy. I think it focuses on the right things. But it's a very long-term vision. And the thing about a long-term vision is it's going to take a while to pay off before people actually see an improvement in their lives. Most of the rest of the Diet session has been focused, or at least, shall we say, the headlines have focused on legislation that isn't really important for people's day-to-day lives. There's a legislation on expanding the imperial household. There was another bill for banning desecration of the Japanese flag. And then there was most recently this bill on setting up a backup capital in case of a disaster in Tokyo. Now, some of these things may be important, but when they're taking up all of the oxygen in the room and people are still concerned about the cost of living, the cost of putting food on the table, and they don't immediately see any impact on that, then people start to say, well, she's not doing the things that she said she was going to do when we had the election in February.
So what's the risk to her leadership if opinion polls continue to weaken, and what are the red flags that you'll be watching out for?
I think the risks right now are overstated. I think, you know, as I say, her polling numbers are still historically very high. Only extremely successful prime ministers such as Shinzo Abe and Junichiro Koizumi had polling numbers this good, this long into a premiership. At the same time, you know, we do need to be conscious of the fact that Japanese leaders tend to be short-lived. And it's whether Takaichi can be an exception to that or not, I think is really the key here. And I think what she needs to do is, you know, as we go into what I assume will be an extraordinary Diet session in the autumn, she really needs to start focusing on the issues that voters really care about. And basically the number one issue that voters care about right now is inflation. Obviously, the Prime Minister is limited in what she can actually do, but she needs to be making the right noises, I think, about what she's doing.
Bloomberg Opinion columnist Garode Reedy there, as we have also seen Prime Minister Takaichi dealing with a massive earthquake recently here in Japan. Soldiers, emergency crews are continuing the search for earthquake survivors in sweltering weather in southwestern Japan. The 7.1 magnitude quake on Tuesday killed at least 18 people, with another 62 injured. At least 3 died in a suspected gas explosion at an Aeon shopping mall, while another 5 were killed when a paper mill chimney collapsed. Prime Minister Takaichi has pledged full support for rescue and relief efforts. We have more ahead. This is Bloomberg.
Take a look at what we're watching across the emerging market complex. A bit of a different picture when it comes to stocks versus FX, right? We're seeing EM stocks, they're looking pretty flat at the moment as we have investors just contending with implications from the Fed's decision to stay on hold. Those 3 dissenting voices, though, very much suggesting that September is in play. When it comes to currencies, we're seeing that gain across the broader complex after the Fed held rates steady, pushing the US dollar lower in response, right? So developing world currencies tracked by the MSCI seeing a little bit of a raise there. Plus, we've also got a rebound in oil prices as well. But how long that's going to sort of be able to be sustained for is a question, given that we still have these ongoing developments and news of more strikes from the US launched on Iran. Well, GoTo Group has reported a straight quarter of net profit, boosting the Indonesian ride-hailing and food delivery companies' efforts to navigate what's been a challenging consumer market. It's also facing a looming cut to ride-hailing commissions. Let's get more on the outlook with GoTo Group CEO Hans Patuwo, who joins us live from Jakarta. Hans, really great to have you with us. So talk us through these numbers, and do you think the momentum can be sustained given that the broader macroeconomic and consumer environment does remain challenging?
Yeah. Hi, Heidi. Yes. So we are quite bullish about the prospects for this year. If we take a look at it, indeed there are some concerns and volatility around the macroeconomic situation. However, I think we've got two things that are going for us. So one is really the emergence of our fintech unit. Our fintech unit posted profitability that is 5x what it was a year ago, and that is really growing very nicely. And in this particular market, where lending and financial services are still relatively underpenetrated, we feel that this will continue to be a strong engine for our growth. The second thing that is helping us is that we have a fairly good chunk of our customers, so coming perhaps a bit more from the urban affluent market, and their demand tends to be a little bit more resilient. So I think with these two things, we believe that we still have some runway to grow this year, even in spite of the existing conditions.
Can you talk about some of the risks then, particularly when it comes to the psychology of the consumer? Do you see downside risks at all in your outlook?
Yeah. So I think there are two parts. One is there is perhaps some concern around, for example, the Indonesia stock market isn't doing that well right now, and the rupiah against the US dollar has somewhat depreciated quite significantly. So I think these are creeping in a little bit, but so far, inflation has held constant. And as long as we see that inflation remain in line, perhaps the overall impact to the overall consumer psychology will be somewhat maintained. It is also very important that the government has continued to keep the price of subsidized fuel, the lowest grade of fuel, to be constant, and that has helped in keeping inflation down. So I think that remains a very critical indicator of kind of how the overall sentiment goes. The second is, there probably we need a bit more clarity around there's some new regulations that are coming in play. And so I think between these two things, if we see positive momentum, we suspect that the overall consumer psyche will remain to be where they are today.
It's interesting you mentioned some of the challenges when it comes to the stock market. The 50 rupiah minimum rule seems to be impacting GoTo shares since about May. Give us your thoughts on this, and would you potentially consider any sort of corporate action to deal with it?
Yes, so we've spent a lot of time thinking and talking about this, so I'll give you the short version. Look, it was really a roller coaster ride, a little bit of a roller coaster ride for us. We announced our Q1 results on April 28, and the market reacted positively. We went up from 51, 52 rupiah up to 58 rupiah. However, then there came some regulatory uncertainty with the announcement of the 8% commission cap. And between that and the overall market sentiment, that brought us down to 50 rupiah and has stayed there since. So look, we do not believe that this reflects the fundamental value of the company, and we believe that our results that we are showing over the long run will prove itself. We have, though, to your point, looked at various kind of corporate action. We have requested from the shareholders and have received in June's shareholder meeting a buyback program. So we authorized to buy back up to 3.5 trillion rupiah, which is just around $200 million worth of stock. Now, we are not exactly rushing into it. We want to make sure that the timing's right. We want to make sure that the macro conditions are right, so that when we do deploy this money, it will have the desired impact. The second thing that we have announced actually is we will be cancelling treasury shares. So we will be cancelling about 2.7% worth of float in the next coming months as we go through the regulatory process.
I wanted to talk a little bit about the fintech side of the business, right? What's your outlook for the rest of 2026? Merchant services, payments, lending, how do you view all of those parts of the business?
Yeah. So this part of the business has been gathering momentum for maybe a year and a half now, and we're really seeing it break through. The number of users is up year-on-year 30%. The number of transactions is up 90% year-on-year. The GTV is up 90% year-on-year. Loan book is up significantly, and so it's really gaining momentum. The first thing that I want to convey is that we are very vigilant on risk. We publish the quality of our lending book, and so far we have been able to hold the risk quality constant. As long as that holds, we will continue to grow. I have to say also that in Q2 we've taken some preemptive measures. We really clamped down, we became tighter with some of our lowest risk quality cohorts. Having said that, the business is still growing very healthily, and as long as we see that the cost of credit remains under control, I believe that the business will continue to scale and to grow. One other thing to note, Haidi, is that we're also getting more and more users, and the penetration rate of the overall GoTo ecosystem users who cross over to lending is still fairly limited, so there's still ample room to grow.
How much slimmer do you expect this business to be after the recent cost and job cuts?
I'm sorry, Haidi, could you repeat, please?
In terms of broader restructuring efforts, recent job cuts and cost cuts, how much more streamlining might we expect to see from GoTo?
We're evaluating that, I think, and we don't have an exact number yet, but we will be looking to optimize our costs. There could be certain areas around marketing that we'll look at, and we will also be looking at some of our other OPEX costs as well. But no specific number yet at this point in time.
Hans, really great to have you with us. Hans Patuwo, who's the CEO of GoTo Group. We do have more ahead here on the Asia Trade. This is Bloomberg.
We're seeing the latest developments on the Iran-U.S. conflict, with local media now saying that they have heard blasts in Iran's Bandar Abbas, not to mention Kish, Kesh, Abu Musa Islands as well. All of this, of course, after we heard confirmation from the U.S. that forces have began launching strikes against Iran. We had a brief pause in the fighting, but the U.S.-Iran fighting has resumed. We saw Brent just surging in the previous session. Right now in the Asian session, though, retracing some of those gains. We're headed towards the market opens in Hong Kong, and we'll be watching Zhongji Innolight set to begin trading in the city today after raising $6.8 billion in the city's largest listing in 7 years. Let's bring in Bloomberg Intelligence Technology Analyst Sean Chen. So, Sean, we actually saw the company A-shares fall in great market yesterday. What does this tell us about what we can expect from the debut today?
Hi, Shery. Thank you very much for the question. I'm actually not surprised by the great market performance yesterday, as Innolight is already listed in Shenzhen Stock Exchange. Its debut actually is driven largely by the relative value, and we saw a large pullback in its A-share performance this week, which has substantially narrowed the discount cushion for the company. But with that being said, we do believe the company can trade at a tighter discount in the Hong Kong market compared with its technology hardware peers. In fact, based on its great market price, that would put the discount to about 12%, making it the third tightest stock among dual-listed tech hardware companies in China.
Why is that?
Well, I think while the median or the average discount of technology hardware stocks in Hong Kong versus their mainland shares is substantial at a median of 43% as of close price yesterday. Let's not forget the range is also extremely wide, from a discount of as deep as 70% to a premium of as much as 12%. And we believe Innolight merits a tighter or slimmer discount versus its peer group because of its leading market share, as well as the scarcity of AI optics in Hong Kong. So the company is the leading maker of optical transceivers for AI data centers, a critical component for the AI build-up. There's simply no comparable stocks in Hong Kong with similar scale. And also, because of its leading market position, we think Montage and the Giga device offer the closest template. Both the companies are actually trading at a premium in their H shares versus the A shares.
So we, of course, continue to see rising geopolitical tensions, right, between the U.S. and China. Given how most of its customers are U.S. hyperscalers, what can we expect for Innolight?
We think Innolight can navigate the geopolitical uncertainties well because we are seeing the companies doing two things at the same time. First, and probably more importantly, is that the company is actively relocating its capacity outside China, mostly to Thailand. One important macro data point I want to bring up is the export of China's optical transceivers. It actually decreased in 2025. Despite triple-digit growth by major players in the sector, indicating that major players, including Innolight, are moving the production away. And actually, one of the main use of proceeds for Innolight's Hong Kong IPO is to accelerate the capacity expansion in Thailand. Another reason is it's actually reducing its exposure in China. The sales mix in China actually reduced from 20% several years ago to single-digit percentage last year. This will also help ease the sensitivity of the business.
Bloomberg Intelligence Technology Analyst Sean Chen there. Let's look ahead in terms of how the sessions across Taiwan, Hong Kong, mainland China are shaping up. We are seeing a little bit of upside when it comes to Hong Kong tech. They're going into the open, perhaps further pressure for Taiwan. We're watching the AI space, of course, moonshot there in focus.